Okay, let's jump straight in. If you follow global energy storage at all, you know contemporary Amperex Technology, or CATL, is the undisputed heavyweight. But lately, the market has been treating this company purely as a high-growth EV play, and that's just missing the bigger picture. Today, by looking closely at verified data and some major recent strategic pivots, this explainer is going to show you how CATL is completely transforming. They are moving away from being a traditional manufacturer and turning into what's basically a technology toll road operator. To break this all down, we've got a packed agenda today. We'll start with the macro picture, dig into the financial reality, and look at how they are building strategic moats. From there, we'll check out the solid-state wildcard, navigate a few geopolitical landmines, and wrap it all up with our final verdict.
Kicking things off with Section 1, the macro picture.
The sheer volume of news dropping about this company recently is just staggering. I mean, in just the last 72 hours alone, CATL has unleashed this massive cascade of material events that totally blows that old EV-only misconception out of the water. We're talking about a confirmed $6 billion US joint venture with Ford. We've got the sudden unveiling of a game-changing 500 watt-hour per kilogram solid-state battery. They just reported record profits for the first half of the year, and they announced a massive European expansion. These headlines aren't just noise, they point to a massive strategic pivot. CATL is successfully pulling off this transition into a technology toll road operator, and that demands a completely different way of evaluating them.
Moving right along to Section 2, the financial reality. Let's look at the August 17th Shenzhen Stock Exchange filings and see how this builds an entirely new financial scorecard.
The headline metrics here are undeniably robust. Revenue is up 24% year over year to roughly $43.8 billion US dollars. And that net profit, it surged a massive 31% to $8.4 billion, which actually beat analyst consensus by a full 4%. But, and this is a really critical takeaway, that 31% actually represents a deceleration from last year's 40% profit growth. You see the easy money of electric vehicle penetration in China? That low-hanging fruit is pretty much gone.
So if EV growth is cooling off to the mid-teens, where exactly is the new momentum coming from? Well, the answer is energy storage systems, or ESS. While the easy EV money has been harvested, the AI data center boom is putting ridiculous demands on global grids right now. That relentless power demand is driving a 30+% premium growth rate for CATL's ESS division. It's effectively acting as the perfect hedge against a sluggish European EV market.
And this right here brilliantly illustrates why you absolutely have to segment CATL in your financial models moving forward. ESS isn't just a side hustle anymore. It is the silver lining that now makes up nearly a third, 28% to be exact, of their $43.8 billion revenue. Honestly, if you are still grouping their EV batteries and their grid storage systems together in your discounted cash flow models, you are fundamentally undervaluing the business.
Understanding that split brings us perfectly to Section 3. Building the strategic moat. Analysts are increasingly referring to this as their toll road model. So let's look at how they're pulling this off, starting with that huge US Ford joint venture.
On August 20th, Ford and CATL confirmed a $6 billion plant in Michigan. But the structure of this deal is what's truly genius. CATL is not putting up the $2.5 billion in capital to build it. Instead, Ford actually owns the factory, and CATL just licenses the intellectual property. By doing a tech license instead of a capital dump, CATL secures three massive strategic wins. First, they completely sidestep the U.S. Foreign Entity of Concern rules, keeping the plant compliant with the Inflation Reduction Act. Second, they protect their own balance sheet from brutal U.S. construction and labor cost overruns. And third, they lock in a recurring royalty stream.
This is exactly why they're being called a toll road operator. It is literally the Intel Inside model, but for batteries. By morphing into a software and IP provider, they completely de-risk their U.S. exposure. It is an absolute masterclass in capital allocation. They are getting paid for their brains, not their brawn.
And the crazy thing is, they're applying the same aggressive de-risking strategy to their supply chain. While competitors are out there getting seasick riding the roller coaster of spot market commodity volatility, CATL took decisive action. Their subsidiary, Brump, just secured a 10-year raw materials hedge with Chile's Codelco. They locked in 70,000 metric tons of lithium and 12,000 tons of cobalt at a guaranteed floor price. Overnight, this transforms CATL from a price taker into a price maker. They have basically secured a cost per kilowatt-hour advantage that is virtually unassailable for the next decade. It's brilliant, cheap insurance against inflation.
With that moat deepening, we have to talk about Section 4,
the solid-state wildcard. We simply cannot ignore the flashy August 19th unveiling of their Tianheng solid-state battery.
Now, make no mistake, a battery pushing 500 watt-hours per kilogram is revolutionary. But as enthusiastic as I am about this tech, we really need to manage our expectations based on the data. Mass production doesn't even kick off until Q3 of 2027, and we won't see these vehicles hitting the road until 2028. This announcement was essentially a massive flex against competitors like Toyota, proving they already have a working production line. So analysts are warning, do not price this long-dated call option into your 2026 or 2027 earnings models. Good old LFP batteries are still going to drive the revenue for the next 18 months. However, knowing they have this solid-state tech in their back pocket, that absolutely puts a hard floor on how low their market multiple can compress.
But look, no explainer is complete without addressing the downside, which brings us to Section 5, Geopolitical Landmines. We'd be totally negligent not to address the 3 glaring red flags waving right now.
First up is what reports are calling the European margin trap. CATL secured a €1.1 billion grant for massive expansion in Hungary. The bull case is obvious. They become the local king of Europe. But the bear case? Well, this grant comes with the EU's famously strict environmental mandates. Specifically, they have to hit a 40% water reduction target. Meeting standards like that requires incredibly expensive, cutting-edge filtration machinery. If their Q4 CapEx guidance spikes by more than 10% to cover this, expect to see a 5 to 8% sell-off as their free cash flow comes under serious pressure.
The second landmine is the U.S. regulatory sword hanging over their heads. Yes, the Michigan plant licensing deal legally avoids the rules today. But if election rhetoric heats up and leads to the U.S. Treasury tightening its definitions of effective control in 2027, Ford might actually be forced to sever the licensing agreement entirely. CATL could be left with completely stranded intellectual property in America. It is a medium to high risk that just cannot be ignored.
And that leads us to the third risk, which actually flips one of their biggest strengths right on its head. We just talked about how brilliant that 10-year raw materials hedge with Codelco was. But you really have to ask yourself, what exactly happens to a floor price during a global recession? This is the inherent danger of the cobalt floor. It's a contract structure that perfectly protects you on the upside. But if cobalt prices were to crash, say 40% in a global downturn, CATL loses all of its flexibility. They will be contractually forced to buy materials from Codelco at above-market, premium rates, all while their competitors are out there scooping up cheap materials on the spot market. It's a highly rigid structure that could hurt them badly if the macro environment suddenly turns deflationary for battery metals.
All right, taking all this verified data into account, we finally reached Section 6, Final Verdict. How do analysts actually view this ongoing transition from a momentum stock to a quality compounder?
The financial analysis provides 3 distinct strategies for the next 90 days, depending entirely on your investing style. In the short term, between now and November, sources suggest expecting some volatility as profit-taking happens around the Ford deal. The strategy here is to look at pullbacks to the 200-day moving average. Whatever you do, don't chase the peak. In the medium term, all focus is on that Q4 Hungary CapEx announcement. If spending stays flat, projections show the stock rallying. If it spikes, analysts suggest waiting for the dip. And for those of you with a higher risk appetite, option strategies like January 2028 leaps are being highlighted as a brilliant way to bypass all the short-term noise of CapEx cycles, giving you leveraged exposure for when those solid-state batteries and the Michigan plant finally come online.
CATL's pivot to an IP and royalty model truly is a total game changer. They are consistently 2 steps ahead of the competition, and they possess an incredible patent moat. But as you review the landscape today, you really have to ask yourself this one fundamental question about the new king of the energy transition. Are we actually willing to pay a premium tech multiple for a company that still carries such heavy industrial and geopolitical baggage? It's a fascinating balancing act between incredible cutting-edge innovation and undeniable global friction. Definitely something to think deeply about. Thanks so much for joining me on this explainer today. Keep your eyes on the data, and as always, keep learning.